All right, I'm going to explain how an index universal life insurance policy really works in about 60 seconds. So let's say you're in your 30s and you want to start an IUL. You're going to put $500 per month into this policy after paying for the cost of insurance, which is roughly around $200,000. You have about $5,000 left over inside the cash value portion of the policy. Now, you have two accounts working for you at the same exact time. You have your cash value growing based on conservative market performance without any risk. And then you have your death benefits, which if structured properly, your death benefits should increase up until a certain point inside the policy. Now, let's say you continue doing that, $500 per month, $6,000 per year for a certain period of time. You have $20,000 in there in a few years, and you want to go buy a new house and you need a down payment. Well, you're going to request a loan from your policy, and here's why. When you take a loan from your policy and deploy it into a home down payment, that balance is still going to stay $20,000, untouched, uninterrupted. The reason is they're going to take a loan from your death benefits, which is actually the general fund of the life insurance carrier. A lot of people don't realize how powerful the loan option is inside of a cash value life insurance policy. Now, the way that it works is your money's not directly invested in the market, but when the market goes up, you participate in a certain amount of gains. When the market goes down, your money's protected from what's called a 0% floor. Now, it's important to note there's caps and participation rates and floors involved, so you have to make sure you do this with somebody who is an expert and knows what they're talking about. But your money will effectively look like a staircase, going up when the market goes up, flattening out when the market crashes, going up when the market goes up, flattening out when the market crashes. Now, let's say you continue funding this policy with $6,000 per year for the next 30 years, and you've accumulated around $400,000 in cash value. You can then elect to take tax-free retirement income from this $400,000 for the next 20 or 30 years. Or you can leave it and you can take it out and you can go blow it on a small island in the Caribbean. Now, with an IUL, if you pass away around that time, your family will get both the cash value and the death benefits, which means your family could potentially get a $1 million death benefit, which is completely tax-free. Now, if you want to learn more, make sure you click Learn More down at the lower left-hand side of this video, and I'll make sure I get some information in your hands. We can potentially schedule a free consultation. I can get your questions answered, and we can see if it's a good fit to work together.